Hello all, and welcome to this video. Today we are going to have a look at non-current assets. There are two main IASs which relate to this. The first being IAS 16, which concerns property, plant and equipment, and the second one being IAS 36, regarding the impairment of assets. So we're firstly going to have a look then at IAS 16, which is property, plant and equipment. So the first thing we need to do is to be familiar with some of the key terms. So property, plant and equipment. This consists of tangible assets. They will be held by an entity for use in production, and they will be expected to be used during more than just one period. Carrying amount. So this is the amount at which an asset will be recognised after the accumulated depreciation has been deducted, and also the deduction of any accumulated impairment losses. Cost. So this is the amount of cash or cash equivalents that have been paid, or could be the fair value or other consideration given to acquire an asset at the time of its acquisition or construction. Depreciable amount. So this is the cost of an asset or other amount substituted for cost less residual value. Depreciation. So this is the systematic allocation of the depreciable amount of an asset over its useful life. Fair value. So this is the price that will be received to sell an asset or paid to transfer a liability in an orderly transaction between market participants at the measurement date. So an impairment loss is the amount by which the carrying amount of an asset exceeds the recoverable amount. The recoverable amount is the higher of an asset's fair value, less cost of disposal and value in use. Residual value. So residual value of an asset will be the estimated amount that an entity would currently obtain from the disposal of an asset. This is after all estimated costs of disposal have been deducted. If the asset were already of the age and in the condition expected at the end of its useful life. So the useful life then is the period over which the asset is expected to be available for use by the entity, or the number of production or similar units expected to be obtained from the asset by an entity. So IAS 16 then of PPE states that we need to do something called initial recognition. So an item has to be recognised then when future economic benefits are likely to flow to the entity, and the cost of the asset is able to be measured reliably. So it also states when an asset should initially be measured at cost. So purchase price, including import duties and net of discounts and rebate, and any costs that are directly attributable to bring the assets to the present location and condition necessary for it to be able to operate in the intended manner. So that's things such as delivery fees, setup fees, installation fees, any costs to actually test the asset, and professional fees. It would also take into account the initial estimate of the cost of dismantling and removing the item, restoring the site. What is subsequent expenditure then? Well, this should be capitalised when expenditure improves the future economic benefits that the asset is going to generate. It will replace a component of an asset and the carrying amount of the component, and that will be derecognised. It should also be capitalised when the cost of a major inspection happens due to faults and the carrying amount of the previous inspection will be derecognised. So measurement after initial recognition then. So IAS 16 states that entities must apply the cost model or the revaluation model. So if entities follow the cost model, they would do the carrying amount as being equal to cost, deducting any accumulated depreciation and then deducting any accumulated impairment losses. The revaluation model is very similar in that you would still deduct the accumulated depreciation as well as the accumulated impairment loss. However, the revaluation model uses fair value for the carrying amount as opposed to cost. So depreciation then, the basics. So the depreciation charge is always going to be recognised in the profit or loss because it is an expense to the business. Land will never be depreciated. It has an unlimited lifespan and it is indefinite. If the residual value is going to be greater than the carrying amount, the depreciation charge is going to be zero. Changes in the depreciation method. So if you wanted to change the depreciation method, you need to review that on a periodic basis. If there is a change in the pattern of consumption of benefits, the depreciation method should be changed to reflect this. So if you change the method which you used to calculate depreciation as an entity, this has to be treated as an accounting estimate and should be applied in current and future periods. However, those in the earlier periods should not be changed or amended. Changes in useful life and residual value. So at the time of acquiring an asset, its useful life and residual value are going to be estimated, and thus these may need to be reviewed. It may become clear over time that the asset isn't going to last as long as you expected, or it may well last a little longer. So any change in this is going to mean the depreciation for the current period and future accounting periods are going to need to be amended to reflect it. So under IAS 16, we always have revaluations to take into consideration. So issues to be recalled with revaluations. If an asset is revalued, any accumulated depreciation up to the date of revaluation should be reversed, increasing the revaluation surplus, which can also be known as the revaluation reserve. Depreciation would be calculated on the revalued amount. If one asset is going to be revalued, that whole class of assets also has to be done. If you had a car showroom and you were going to revalue one vehicle, you would have to revalue them all. So revaluation frequencies then are going to depend upon the volatility of fair values of the asset class. The more volatile, the more frequent the revaluations are going to happen. So obviously it's not straightforward, and there are certain steps that have to be taken into account when completing the accountancy side of it for revaluations. So the first step is to actually restate the asset cost to the revalued amount. You would then remove any existing accumulated depreciation. Once that has been done, you would need to transfer the increase in the cost account and the existing accumulated depreciation to the revaluation surplus account within equity. And finally, you would need to recalculate the current year's depreciation on the revalued amount, should it be applicable. If the revaluation happens at the year end, the depreciation charge will only affect future years. But if it happens at the beginning of the year, it is also going to affect the current year. So we can have upwards revaluations of PPE. So if that was the case, we would need to debit the asset at cost account, which is going to be our revalued amount, less our original cost. We would need to debit our accumulated depreciation with the depreciation up to revaluation date. And we would need to credit the revaluation surplus, which would be the revalued amount less the previous carrying amount. Contrary, you may have a downwards revaluation of PPE. So this time we would do the opposite. We would firstly debit the revaluation surplus, only to reverse the upward revaluation. We would debit the profit or loss account with any excess once the revaluation increase has been reversed, and we would credit the PPE at cost account. Retirement and disposals then. So an item of PPE is going to be eliminated from the statement of financial position on disposal when the asset is permanently withdrawn from use. So that is going to lead to a gain or loss on disposal, which we can calculate as being net disposal proceed less the carrying amount. So that gain or that loss on disposal should then be recorded into the statement of profit or loss. Within that, it should also be listed in the appropriate expense category. So remember, if you have a loss on disposal, that is going to increase the expense, and a profit is going to reduce the expense. So disposal of revalued assets then. So a gain on disposal is going to be measured as the difference between the carrying amount on the statement of financial position and the proceeds received. If an asset has already been revalued in the past, it is going to have an unrealised gain in the revaluation surplus that must now be removed. The amount should be transferred from the revaluation surplus to retained earnings. The movement is going to be seen in the statement of changes in equity, but it is not going to affect this year's profit. So with IAS 16, there are also some disclosure notes that do need to be had. So for each class of PPE, IAS 16 states that it must be disclosed. How has it been measured? So is it measured on cost, valuation, or something else? What depreciation methods with useful life have been used, and also the depreciation rate if applicable. It must disclose the gross carrying amount and accumulated depreciation at the beginning and at the end of each period. Any additions, disposals, revaluations, impairments, or depreciation must all be reconciled. So once assets have been revalued, there will be a basis of valuation, there will be a date of valuation, it will state whether an independent valuer was used, it will state the carrying amount if no revaluation had taken place, and whether there was a revaluation surplus. All of that must be disclosed in the notes. So just a little example here as to what you could be looking at in terms of dealing with revaluations, and this is what the template would look like. So moving on to IAS 36 then on the impairment of assets. So essentially all this means is the amount by which the carrying amount of an asset exceeds its recoverable amount. So obviously you need to know how to get to the recoverable amount. So the recoverable amount is the higher of the net selling price, which to arrive at that is the fair value less the cost of disposal. Or it is the value in use figure, which is the present value of estimated future cash flows arising from use and disposal of an asset. So there are some situations that could indicate an impairment of an asset. So this is not an extensive list, but just to name a few. It could be decline in market value. It may be due to technological, economic, or legal changes. It could be physical changes. It could be that an entity already has plans to dispose of an asset. So how do we check for impairment then? So is the market value declining more than we had expected? Is there significant changes with an adverse effect? And has there been a rise in market interest rates? It could be that there's evidence for obsolescence or physical damage of an asset. It may be an internal reporting evidence that may well indicate the economic performance is on the decline. So that's just a few ways that you can check, and there are other ways to do that. So, recognition and measurement of an impairment loss then. So an impairment loss occurs when the recoverable amount of an asset is below its carrying amount. So an impairment loss should be recorded as an expense in the statement of profit or loss, unless the asset has previously been revalued upwards. Obviously, if the asset has been previously revalued, the impairment can be offset against the revaluation surplus. So again, some disclosure is required here. So the amount of impairment losses recognised in the statement of profit or loss during the period and where has it been included. The amount of reversals, impairment losses recognised in the statement of profit or loss during the period and where that has been included. The amount of impairment recognised directly in equity during the period. And finally, the amount of reversals of impairment losses recognised directly in equity during that same period.